What's the IRA mistake almost all retirees make? Picking funds and diversifying your portfolio isn't enough. You have to have a plan. Good financial advisors and smart investing DIYers have something in common when it comes to building a portfolio. They both put a high priority on risk tolerance and how it applies to asset allocation. After all, a diversified blend of stocks, bonds, and cash is the well-established path to reaching your retirement goals. It helps you grow. See also. Well, yes. But if that's your own, I see people, even some financial professionals, make this mistake all the time. They determine risk, and that's it. They're investing, and unfortunately, they haven't put much thought into how those investments will be taxed when they retire and start drawing income from their savings. All too often that's bad enough, but when I see an investor whose portfolio includes taxable and tax-deferred accounts that mirror each other exactly, it really makes me scratch my head. When it's a retiree, the problem? That investor is, but she doesn't have to do it that way if she also has a taxable account, which doesn't have RMDs and offers other advantages for handling the growth in her portfolio, including tax harvesting possibilities and profits that are taxed at the lower capital gains rates, instead of as ordinary income. Erase a hypothetical. Let's say our investor, Sandy, is 70 years old and has $500,000 in her IRA and $500,000 in a taxable brokerage account. For the next 20, sounds pretty simple. Except that Sandy was off to the right start worrying about risk and determining which specific stocks, bonds, and other investments best met her portfolio needs. But she or her strategy could have been to place her more conservative investments, those with lower expected returns, in her tax-deferred IRA and her more aggressive higher-earning assets in her taxable brokerage account or a Roth IRA. Each account if, like Sandy, you have the same or a similar blend of investments in your accounts, it's probably going to cost you. But if you coordinate, I believe managing taxes in retirement and pre-retirement is just as important to financial success as choosing the right investments. If you don't have you've worked hard to build your nest egg. Don't lose that money. See also. Kim Franke Falstad contributed to this article. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC AEWM. AEWM. This article was written by and presents the views of our contributing advisor, not the Keipelinger editorial staff. You can check Copyright 2019 The Keipelinger Washington Editors.
Raindrop, drop top, top smoking, no cooking the hot pot. Fucking on your bitch, yeah, that. Looking up, open the park,